Joining us from Philadelphia, from the Wharton School, we have the professor of finance, Jeremy Siegel. He, by the way, also wrote Stocks for the Long Run, which the Washington Post says is one of the 10 best investment books of all time. Jeremy, good to have you on the program.
Yeah.
What do you think of this European debt crisis and these big talks taking place? What do they need to do right now?
Well, I happen to agree with Charlie Munger here. I think the ECB has to come up really big, quite similar to what the Fed did after the Lehman crisis to patch up the system. I think they have to guarantee all the deposits in all the major Euro banks. I think they have to guarantee senior debt to make sure that at least in the short run these banks are functioning. I think they should ensure counterparty risks and counterclaims and short-term borrowings and money market funds. And I'm not done yet. I think they should ring fence the toxic assets, which of course are sovereign debt, mostly in Europe. Remember what the Fed did? They said, I'm going to take the current market value and I'm going to do a non-recourse loan, 90% of that value. You can borrow any amount up to 90% of those values. That's not bailing out Greece. That's not guaranteeing that at face value. I think what they should do is look at the values of the last 5 days, 10 days, say that's the minimum. We'll loan 90% against that. What we have to worry about is disintermediation in the European banking system. It's so important for the ECB to come up with a liquidity position that guarantees that that won't happen.
How much is that going to cost, though, Jeremy? We were talking about maybe €1 trillion in the EFSF. What about all this ring fencing, all this liquidity that the governments have to provide? How much is the big bill at the end of all this?
Well, you know, what it will do, if you really come up big, is probably, and this isn't how much they have to spend, you understand. This is how much they will have liquidity backing the European banking system. It could be 5 trillion euros. But if they just announce, we have this, we're going to back it, there will be such a rally in the markets and a feeling of calm that I don't think they're going to have to use very much of that at all. Again, I'm not trying to guarantee Greece. What I'm saying is they have to put a bottom behind these assets, just like the Federal Reserve did 2.5 years ago.
Look, they're also asking for the private markets to help out as well. They want these bondholders, private bondholders, to voluntarily, mind you, accept a haircut of 60%, which I guess in some calculations is just to 80% of their holdings of Greek bonds. I mean, is that realistic in their view to have investors try to cough up and eat some of these losses?
Well, I mean, what you understand is Greek debt is already selling at 40 to 50 cents on the euro. I don't think I would want to force a settlement on. I would just say, this is what I'm going to lend against those values. I still think if they lend against the values that now exist, that most of the banks will still have capital, diminished capital, but capital. Those banks that don't have capital at these minimum values, they may have to inject capital, they may have to merge them into stronger institutions, again, very similar to what we did in the U.S. But that calmed the system, you know, after the Lehman crisis and brought lending back into the system. And it turned out that outside of Fannie Mae and Freddie Mac, for the private banking system, it didn't cost the Federal Reserve a dime. And I don't think for the ECB it will cost very much if they don't wait too long and back up the system now.
Okay, well, the rescue package that came after Lehman's collapse came with a lot of political, shall we say, currency as well, a lot of political risk. Do you think that these politicians, Sarkozy, Merkel, Cameron, all of them are brave enough right now to take these measures, especially when they have to answer to their constituents, their taxpayers, their voters as well?
You know, I think if you're not going to guarantee the debt, and you're going to say, I'm just going to put a floor under, I mean, the current prices are extremely depressed. I mean, even for, you know, Portuguese debt and Spanish debt. So all you're saying is at today's prices, I will provide a loan of 80 or 90% against those values. We'll wait for the market to sort out whether you're going to get 100 cents on the euro or not. And if I think that if they came up this big, I think European equity markets would rally 15, 20%, and that would convince the leaders, hey, we'll go along with this. And I think it would convince the electorate because they won't be guaranteeing the debt. What they're doing is putting a floor and seeing where everything falls.
Jeremy, thank you so much for your interesting insights. Good talking to you this morning. Jeremy Siegel of the Wharton School joining us from Philadelphia.